everybody. It's Austin Edelman with the Office and Industrial Podcast. Today I'm joined with Brian Adams of Excelsior Group. How are you doing today?
Hanging in there. It's almost Friday, so I'm doing well. Thank you for having me on.
Looking forward to the weekend.
Absolutely.
But yeah, so we just wanted to talk a little bit of the office market. We're seeing a lot of stuff going on with the COVID virus as it continues to kind of spread across the U.S. But to start off, what states are you kind of seeing being most affected in the office sector?
Yeah. So as background, we run about 2.5 million square feet in secondary markets, Southeast Midwest. We're based in Nashville, but we're in 12 markets total. So we have some pretty good visibility into what the middle of America and the South America looks like right now. Obviously, there's a lot of chatter, and you're seeing a lot of headlines about what's happening in San Francisco, New York. For our standpoint, we get a lot of questions. What do you think about office right now? How is COVID impacting office? The one response that I typically give is it's too early to tell because, as you know, office leases are 5, 7, 10 years out. And if they're credit tenants, those are contractual obligations. So it's hard to know what's happening in real time. I think it's going to take a while to shake out. But I will say, if I was a landlord of a tower building in San Francisco or downtown New York, and I had a lot of tech tenants or WeWork as a major tenant, I would be pretty nervous. I think moving forward, convincing people to take a car to a bus, to a train, to a subway, to go onto an elevator and take it 40 stories up, I think that's going to be hard to convince folks to do. If you take a step back from just kind of the logistical questions, I think those states and cities in the coastal markets have a real challenge because as the tax base leaves, as affluent people migrate out of those places to the Sun Belt or more tax and business friendly markets, they lose that tax income. And so they have to increase taxes to everybody else, and they have to decrease the services they provide. And so it's kind of like a death spiral where it's going to take them a while to dig out from that. Because I think it's just going to spur more and more affluent people who are mobile to leave, and employers are going to start tracking to where employees are going to obtain and maintain that human capital and employee base.
Yeah, I definitely think migration is going to play a key part. As you said, those coastal cities, even with the higher prices, of stuff that we're seeing in California, investors are looking for opportunities where their yield is going to be better than, some of those major technology hubs such as San Francisco and areas like that. That's interesting that you bring up the WeWork perspective. There are a lot of those larger Class A office buildings that a good proportion of their rentable square footage is leased to those guys. How do you see those guys kind of transitioning and either finding someone else to take on those spaces or what would be the best use moving forward?
Yeah, so WeWork was the largest tenant in Manhattan on a square foot basis. And it's interesting because initially during the COVID period when WeWork was blowing up, independent of what was happening with the virus, they have their own issues. I thought, man, co-working, this whole concept where we're going to squeeze as many people as possible into as small a space as possible. And in addition, we're going to make that space exceedingly expensive to build out. I just thought, I don't understand this model. I don't get it. And I thought the world of hoteling and benching and hot desking was going to go away. But increasingly, as I've talked to other landlords and sponsors and folks in the space, and we actually have Regus in a number of our assets, I actually think transitioning to this hub and spoke model where, people aren't working from home, they're working remotely in other secondary markets. I think co-working, if you're well capitalized and a well-run business, I think it has a real opportunity to be a market player in today's space, but just not that density. I mean, some of these WeWork locations had 75 square feet per user, and a traditional office layout is more like 250 square feet per user. So I think we'll see a return to more of that old school Regus style where people will be using, co-working, but it'll be more office layouts, closed doors, and then maybe some communal areas and amenities that they can all share. So I do think there's the opportunity there. I think WeWork had its own, issues with that were intrinsic to itself and not emblematic of the entire industry.
Yeah, yeah. No, I agree. I think after COVID kind of begins to clear up and there's kind of a cure or something that will, help people not catch it as rapidly as we're seeing right now, I think those Regis concepts will work. Possibly even something like maybe these tenants that did have a large portion of square footage before COVID, maybe they take on something a little more short term, but it's still enclosed to where only their employees can use the common areas and stuff like that. So I think there could be the possibility of a transition to where something's more user friendly for people that may work the majority of the time out of their office, but gives them the opportunity to come in and, brainstorm with their team or work through projects and kind of keep stuff flowing.
Yeah, I could see a situation developing where, the CBREs and the JLLs of the world and the Cushions of the world, they were all rolling out their own flex office co-working concepts internally. And I could definitely see a fact pattern or a scenario where if they're doing the leasing and the management on a large asset and an office user says, hey, I don't need as much space as I used to because my workforce is lower, I could certainly see them saying, well, let me take back 25, 50% of your space and we'll backfill it with one of these flex concepts as a way to kind of maintain, occupancy in the building. I could certainly see that occurring.
Yeah, I think that would be something good for, these building owners because, right now, a lot of the people that we talk to, a lot of them are having rent deferrals where some of these tenants that maybe haven't been operating for the last couple of months, they're looking to, get something back out of it. And I think that would be a good opportunity moving forward is that if some of these guys, maybe they can't utilize the full square footage that they were in prior, instead of just, backing out on 3 to 5 years of lease term remaining, they could give it back to the, the landlord and just utilize it for something through a large real estate group, like you said, JLL, Colliers, Cushman Wakefield. I think it'd be good to see that moving forward.
Yeah, it's going to be let's make a deal time.
Yeah. Oh, yeah. Well, so you mentioned earlier a little bit about the population density moving to different areas. What are you seeing in that sector?
Yeah, so we've done a lot of homework on the millennial population and demographic shifts and all that leading up to COVID. That was kind of one of our investment theses was secondary markets would see this huge boom. COVID, I think, is like a lot of things, is accelerating what was already existing. So millennials are now the largest working population in American history. It's about 75 million people total. I barely qualify. I'm on the outer edge of the definition.
Right on the fringe.
Yeah, for better or worse. And I think 2008, the Great Recession, it delayed their family formation phase, but it didn't end it. So what you're seeing is now that they're entering into their mid to late 30s, they are having children, they're getting married, and they're making choices about where they want to live, work, and play based on quality of life, cost of living, access to single family homes, and access to education for their children. So secondary markets, suburban areas make a lot of sense there. I think for all of us, we come out of college and we rebel against the childhood that we had and the experience that our parents had. And we say, we'll never live in the suburbs and drive an SUV and send my kids to this school.
Yeah.
And then you realize I've got 1.5 kids. I'm living on the Upper West Side. I'm getting taxed to death and I'm going to move back home. And, it happened with our parents and the baby boomers, et cetera. So we're seeing that play out in real time. I think it's just going to be, accelerated because of COVID, specifically because that urban density and that mass transit issue.
Yeah, that's what we're seeing down here in the Dallas-Fort Worth market as well. It's pretty interesting because you've got major suburbs, including Keller, Southlake, kind of those affluent areas on the north side of Fort Worth. And then even when you're looking up in the Frisco area and Prosper on the north side of Dallas, that's where a lot of the affordable housing is kind of being built up. But it's interesting because also, everybody's familiar with the $1 billion mile out in Frisco where Jerry Jones has put the Dallas Cowboys headquarters. We're seeing a lot of office and industrial development out in those sectors. So it's also a good opportunity for city centers to almost kind of move. and transition away from your typical, CBD area, and you start to see these new economies kind of growing out of the suburbs now.
Yeah, I think what you'll see is the rebirth, at least in America, of the 15 or 20-minute city, right?
Yeah.
So you've got the major CBD area. Dallas is a great example.
Mm-hmm.
It's a market without a lot of geophysical barriers, so it just sprawls.
Yeah.
And so you're going to have the mothership, the traditional area of Dallas where a lot of the corporate headquarters are. But I think increasingly you'll see these little nodes of, urban, suburban areas where people can kind of live, work, and play within 15, 20 minutes, and then go into downtown where they need to, maybe once a week or a few times a month. I think you'll continue to see that. And that's been kind of the model in Europe for a long time.
Mm-hmm.
And I think initially it was in America. We got away from that. I think you're going to see a rebirth of it.
I think you're right. You're always going to have people that, and now what's popular with the millennial generation is instead of maybe taking a vacation abroad, going to Europe or, some island resort type setup, a lot of those families are starting to do the staycation. So I think the downtown's still going to be relevant moving forward. You're always going to have celebratory occasions where you go out to the nice steakhouse and maybe go visit the art museum in downtown or something. So I think it's going to be a good mix of the areas that people want to hang out during the weekdays, maybe go grab a cocktail or, a light bite to eat during the week near their homes, but they still have the opportunity to come to a downtown area and utilize the amenities there as well.
Yeah, I think that's the key is giving them access to the amenities that they became accustomed to while living in the big city, mm-hmm. just so that they can get that flavor, but still maintain that quality of life that they can have in a more of a suburban setting.
Yeah, yeah. And you think that COVID is going to increase that migration to where they're leaving the suburbs and starting to get out to those areas quicker than what you would have expected earlier on?
Absolutely. If you look at the U-Haul data, these people are just fleeing California, they're fleeing New York, they're fleeing high tax coastal cities, and they're moving to places like Texas. I mean, just look at the numbers. Texas and Florida are far and away, the largest growing states. I think this census, New York and California are going to lose a number of congressional seats, and they're going to give them to Texas and Florida. So that's a real-time demographic shift that you're seeing. And I want to make sure that I'm not saying that those places are going to die. New York and San Francisco are going to maintain, relevance. And what you'll see is a cycle where after this millennial population leaves, it'll become more affordable. And so younger people will flow in, they'll love the excitement, the novelty, the amenities, but then they'll meet, Joe or Shirley at the bar and things happen, and then they'll move back to Dallas or Frisco or wherever. That's just the nature of life.
How do you think moving forward that's going to change the dynamics of office and industrial investments kind of in those markets? Is it going to give them the ability to kind of revitalize? And because a lot of those assets and markets like that, a lot of people see them as capped out. Do you think it's going to give them kind of a pushback to where there's more ability to grow value out there?
I do. I think if you look at suburban office, it's gotten, a bad name. Maybe over this cycle, there was all the equity and the deals were chasing, tower deals and CBD, and cap rates were just terrible. Mm-hmm. But if you look at suburban office, it's a very resilient asset class. And the nice thing about it in a COVID world, it's affordable space. You can park density very easily. It's got great parking ratios, typically good access to interstate. And in an auto-centric market, which people are not going to be taking mass transit, it works well. And you have the space, right? So, where you were cramming people into these dense tower deals, suburban office allows you to have an affordable lease rate and have enough space to fill everybody out and to be able to have them be comfortable there. So, I could certainly see a rebirth of the suburban office market. I think you need to be really cognizant of the vintage of the assets, right? So for you and me, I'm not sure how old you are, I don't want to age you, but if you're in your 30s or 40s, a vintage of 80s or 90s seems like it's relatively new, but it's actually pretty long in the tooth. And so
Yeah.
for office buildings, that 15 to 25 year mark makes a big difference, because that traditionally is when you start wearing out elevator, roof, and HVAC, which are just killers when it comes to capital expenditures and deferred maintenance. And so I think newer vintage product in that 2000s range, you can put in air purification systems, or they may already have them. Elevators still have 10 to 15 years of life on them. Roof is still original and has a lot of runway left to it.
Yep.
I think those assets will do really well. I think older vintage product is really going to struggle.
Well, it's going to be the issues of people aren't going to want to put too much money into it that they don't need to. So if there's an opportunity for value add where maybe you spruce up some of the interior features like an air purification system, you know, maybe LED lights, something that's going to help with the electricity throughout the property. That types of properties, I think, moving forward are going to be more interesting for a lot of people. Because like you said, nobody's going to want to move in and throw in a new AC unit or possibly have to rework the elevators. That's not something that people are going to find value in moving forward, and maybe boosting rents possibly.
Yeah, I mean, we love that 1 to 2 to maybe 3-story building where you can legitimately take the stairs as opposed to the elevator, so they have a lot more runway on life with them. And I see a lot of deals and sponsors doing suburban office, and they talk about this huge discount to replacement cost, but it oftentimes doesn't take into account $150,000 for new elevator, $250,000 for new roof, and those things essentially go to your basis, right? And you can never run away from your basis.
Yeah. No, I mean, I think that's good. You know, we're seeing a lot of things going on right now in the world, and not many people are sure which direction it's going to take or where we're going from here. But I was actually looking at your LinkedIn the other day, and you post a lot of stuff about the stock market. And I saw that you kind of got out the other day. You said early March, but now you're still seeing, you know, markets kind of all over the place. What do you see kind of moving forward? Is there going to be investors jumping ship and possibly looking to move their assets into something more stable, or what have you kind of been hearing?
So I will caveat this with, I've been in the commercial real estate business for 10 years. My wife's family's been in it for 35. I think I'm barely qualified to talk about real estate. I am certainly totally unqualified to talk about the stock market, but it is fun to provide commentary and color. So this is not advice, but I would say that when you've got the Fed and Congress creating this massive amount of liquidity into the marketplace, and bonds are yielding zero, corporate debt is really risky, private credit valuations seem stretched, all that liquidity needs somewhere to go. And so that's why you're seeing this huge run up in the stock market and the disconnect between the stock market and what I would call the real economy. So when you have all that going on, it seems like it's just going to keep going up forever. But I think the reality is, and what I've talked to a lot of family offices and high net worth individuals who are multi-generational in terms of their horizon and mindset, would you rather have 5% more upside or risk 20% down? And so what I've seen a lot of them do is take chips off the table. Everyone's really nervous about what's going to happen in the election in November. So I've seen a lot of folks kind of capture those gains, and they're redeploying it into, real assets of one type or another that provide some kind of income generation, that provide tax efficiencies that you can't get in the market, and a hedge against inflation. And so that's why you're seeing, or at least I'm seeing, cap rates pretty much maintain where they were pre-COVID, or maybe even go down a little bit, because a lot of that capital is looking for somewhere to go. And so on a spectrum, you've got hospitality and retail just getting crushed. That's going to be a long time to come back. Office is probably somewhere in the middle, but I've seen cap rates go down in industrial distribution, data centers, cell tower, because they're safe haven assets.
Oh yeah, that's what we're seeing. You know, a lot of the industrial stuff, that's what everybody sees as being pretty stable through all this. You've got the online retailers like Amazon. They're building new distribution facilities in Dallas right now. So there's nothing that's really slowed down on their. So those are seen as more as a safety net. But like you said, I mean, hospitality and retail, those guys have been getting hit the most. But we've actually have a retail guy working in our office, Kirk Searcy, and he's got a couple deals on market right now. They're a bit of a value add play, but there's still a lot of interest in those. You've still got retail owners that are interested in maybe picking up a deal, and there is a little bit of a discount, but not too much, so.
Yeah, and I think one of the questions I get a lot from my investor base is, why aren't you seeing screaming hot deals? Like, why aren't you sending me these 2008 style distressed seller? We can put money to work and we can flip it in through 2-3 years. Well, the problem is that the regulatory environment is so accommodative and the debt is so cheap that there just hasn't been that kind of distress, and leverage was much lower now than it was in 08.
Yes.
And so I think there certainly will be some opportunities in the sectors that we talked about, but it's going to take, I think, 6 months maybe to really shake out and run through that whole banking system. So you've got to be patient. If that's what you're looking for, I think it will come, but I think it's going to be Q4, Q1.
Yeah, I think you're right. I don't think it's something that is going to be seen within this year. That's what a lot of the guys that we talk to, that's their first question. Where's the discounts? Where's the deals? Like, why aren't we seeing anything, that's cheap or distressed, and it's just not there right now. Like you're saying, a lot of these banks, they provided loans, there's
or 90-day mortgage waiver, right? I mean, that buys you a lot of time, or there you can switch to interest only. And if you're not going to be amortizing that debt, that buys you 6 months probably.
Yeah. So we're not seeing the full force of what the possibilities are for these owners down the road yet, because it's still fresh. This is only 4.5, 5 months into this, and it's almost still a shell shock situation where people are still scrambling to figure out, well, how are we going to maintain this long term? What do we need to change, this and that? So I think a lot of people were just kind of expecting that it was going to be a fallout that was quick. And we're not seeing that. Everything's pretty stable. There are issues, but for really what we're seeing in DFW, people are just trying to push ahead. And I think that's going to be key in what we see, like you said, Q4, Q1, 2021.
Yeah, I mean, across our portfolio, we're probably at about 93% rent collection. It's about average for us, frankly, month to month. We certainly have had a couple of users that have exposure to hospitality, leisure, travel, and they're struggling. And so we're trying to work with them. But, the PPP funding bridged the gap for a lot of these users. So, yeah, I mean, I think it will be 3 months on the early end, but probably more like 6 months until you see those type of opportunities.
Yeah. You mentioned the lending environments, being lower than 2008, during the crisis. Are y'all having any difficulty with getting loans, or have you been talking to lenders, and what are you kind of seeing on the debt side?
Yeah, so I'd say 75% of the portfolio is CMBS, and that market is just non-functioning right now, 100%. So we had a deal in Kansas City that we had raised for, and through diligence, we were hoping to close it first week of April. CMBS blew out, so I had to get a new lender, and I had to backfill some equity. I had some high net worth individuals who, rightfully at that time, their stock market portfolio was down 30-40%.
Oh, wow.
But the deal was a good deal, and still is a good deal. So we were able to raise the replacement equity, and we ended up going with a regional lender. And I think you've probably experienced this or heard this. You need to have 2 or 3 really good regional banking relationships or community banking relationships, because those guys will be there when you need them. They're not always going to be the most competitive or win a beauty contest, but to be able to call up the guy that you know from golf or tennis or from your kid's school, they'll be there for you.
Oh, yeah.
And so they were able to come in and kind of provide some bridge financing, and we're hoping to backfill it to permanent. But yeah, I mean, you're seeing Lifeco come back to the marketplace. CMBS, still very, very sensitive. The B-piece buyers are not comfortable with pricing. So I'm not really sure where that's going to go near term. But I certainly think the deals that we're looking right now, we're underwriting as if we're working with life companies.
Okay. Yeah, that's like you were saying earlier, just the regional banks, the people that are kind of in the community. That's where we're seeing a lot of the rates generated from, the ability to go out and source the debt. But the national guys, they're kind of too busy doing other stuff, trying to make margins on products that they're pitching out to their clients. So it is good to have those guys, kind of a backfill. We're actually working on a deal out in Greenville, Texas. It's a dialysis center. And we've got a few guys that were interested in taking a stab at it. And they were like, I call up my guy at Wells Fargo or one of the bigger banks, and they can't get them on the phone. They're like, hey, we don't want to mess with that right now.
Yeah.
But, we've been fortunate enough to have people within the DFW area that we can reach out to. And they're like, yeah, send them over. We'll get them taken care of.
And it was the same with the PPP situation. We applied. We have 12 employees total, and a lot of folks in my network. It was really, I've got a great guy at B of A, or I've got a great guy at JP Morgan or Goldman.
Yeah.
You were the bottom of the stack, right? But we worked with a bank in Nashville called Pinnacle. They're kind of a regional Mid-South, Southeastern-based group. And it was, bam, like we got everything taken care of, texting the guy. They worked 15 hours a day to get it done. And so that was a good lesson for me since, I haven't been through a full cycle yet. So it's a really good lesson for me to know that I probably need 2 or 3 more of those type of relationships and always keep them close because, the guys that I knew at Deutsche Bank or Wells Fargo, where we do a ton of CMBS work, no answer. Yeah.
Weren't there. Well, yeah, that's good. So just kind of ending it up, what are you seeing as the outlook moving forward? What's kind of your plans for what y'all are doing and what's the next step?
Yeah, we continue to be a big believer in secondary market suburban office. We think it's a very resilient asset class. We think as this population shift occurs and you see employees coming to these places, employers are going to want to, take advantage of that human capital shift. And I think it's important to draw a distinction between working from home and working remotely. So when you see headlines, Twitter, Facebook is going to let everyone work from home. Well, no, they're letting them work remotely, which is different. So I think you're going to see a hub and spoke model where, the mothership will be in San Francisco or New York, but they'll start rotating more people to Austin, Denver, Nashville, and that'll start to trickle down because those markets they already are expensive, but I think they'll get more expensive, frankly. And so even secondary markets like Kansas City's, the Fort Worths of the world, I don't know Texas that well, but maybe like a San Antonio would make a lot of sense. I think you'll see them grow. And, pre-COVID, 4% of the workforce worked remotely. Clearly, it's going to be more post-COVID. But I think office still has a role to play in people's lives. And I think we'll continue to kind of need access to an office moving forward.
Yeah. And I think you're right. You look at kind of those areas like Austin, where a lot of the technology firms are kind of moving part of their workforce to, they're building stuff left and right out there. So it's interesting because if you travel south down 35, I don't know if you're familiar with like the San Marcos or the New Braunfels.
San Antonio and Austin are becoming one metroplex.
Yes.
But when you go to the Domain, you feel like you're in San Francisco. It's unbelievable.
I know. Yeah. And that's what I think you're right. You're going to continue to see those people pushing towards San Antonio, where it almost becomes like a version of Dallas-Fort Worth, where they're 2 separate cities, but they're basically combined with the population. And that's what you're starting to see down there in the Austin, San Antonio.
Yeah, markets where they've got, good local politics, good local state level budgets, but they can still be a nice, quality of life, cost of living option for folks. I think what we're seeing in the upper Midwest, Kansas City, we're really bullish on it because Chicago is imploding.
Yeah.
When you tell affluent people and affluent employers that your plan to bridge your funding gap is to tax them more, you will realize that they're mobile and they will go elsewhere. And again, we saw that pre-COVID. I think we'll continue to just see that more of that post-COVID.
Oh yeah, definitely. Well, hey, I really appreciate you joining us on the Office and Industrial podcast. But look forward to seeing what you do down the road going into the end of the year, and we'll stay in touch.
Yeah, thank you so much for having me. If anyone's interested in connecting, I'm very active on LinkedIn. You can look me up, Brian C. Adams, or check out our website, excelsiorgp.com. If you message me, I will respond, and I'm happy to give you as much advice for whatever it's worth as I can. So please reach out. I'd love to hear from you.
All right. Well, good deal. Hey, I really appreciate you coming on.